Hello, this is Rich Vessel, founder of Advanced Projections, with our March 2024 economic report. First, to note that our reports will now be issued between the 20th and 25th of each month, as we must await the results of FOMC meetings as well as leading economic indicator and margin borrowing data published in the latter half of the month. We may resume publishing earlier in the month when interest rates have leveled out at the end of this Fed cycle, perhaps in 2026. Employment figures for February came in with another decent new jobs figure, up 275,000, but the unemployment report or unemployment level moved up to 3.9%. We continue to expect unemployment to gradually move upwards to over 4%. Employment is a lagging indicator in the business cycle, so it typically declines after a downturn has begun. We have included a couple of charts which have been present in our last couple of monthly reports, which show the characteristic hooks in unemployment data that precede recessions. In the second chart, we've removed the COVID disruption from the data so as to better illustrate these kinds of trends. And again, remember that unemployment went up to 3.9% from the February report. Annual CPI inflation through February was announced on March 12th, with the actual reported value as 3.2%, which was again 0.1% above expectations and 0.1% above the January 3.1% reading. Additionally, the core CPI that leaves out volatile food and energy prices was still 3.8%, and sticky price inflation, less food and energy, continued high in February at 4.6%, which is still about 2 times higher than what the Fed wants to see. As oil prices have moved back up over the past few weeks, recently in the mid to high 70s per barrel territory and now over $80 a barrel, motor fuel prices will likely be adding a bit to the CPI headline inflation numbers in the months ahead. The Federal Reserve Open Market Committee maintains their paused rate hike program here in late March, after last increasing their Fed funds rate back on July 26th of 2023. So this key interest rate remains at 5.25% to 5.5%. However, their dot plot once again changed from just 3 months ago, signaling more higher for longer on the interest rate front. We discussed this later on in this report. The continuing solid employment picture is also confirming a higher for longer rate scenario. Last June, the Fed had essentially promised 2 more rate hikes in the second half of 2023, and July delivered the first. We now consider the low probability of one more surprise increase, as core inflation and the sticky inflation numbers are still double where the Fed wants to see them end up. This final increase may come anytime between now and the end of the second quarter of 2024, but the probability of it actually happening is now less than 50%, as long as the core and sticky inflation numbers don't get out of hand and begin trending upward. The S&P 500 index pushed deeper into bubble territory once again, closing February at just below 5,100, and it's now well over 5,200. A significant equity run-up in late February continued in the first half of March and continued right through the release of the latest inflation numbers on March 12th. We had expected some irrational exuberance for a few weeks after the Fed's fourth quarter dot plot came out at the end of 2023. But then we were hoping for more realistic outlooks for the economy and fourth quarter corporate earnings, which should have taken hold of equity pricing, even while our measures of market overconfidence had again returned to the levels, extreme levels of July in 2023. Such is not the case at the moment, however, as equity indices have been setting new records. There is too much cash and too much enthusiasm still available to feed into this equity bubble. Most popular financial press outlets are saying that, quote, markets are behaving typically and are not in a bubble. We claim this is utter nonsense. Our indicator system keeps our recession risk level actually down a bit to 80% due to leveling off of previously declining leading economic indicators, somewhat less hawkish Federal Reserve monetary policy signals, and ongoing red AP indicators. One AP indicator shows yellow and the other 5 are red. And we have temporarily modified the balance between the OECD and Conference Board leading indicators, which then turned ours red for the past 3 months, including February. Now, here are the current underlying economic details. Year-over-year consumer price index increases and tight labor markets continue to characterize our economy. General expectations out just ahead of this February CPI announcement were for 3.1% year-over-year inflation, and it came in at 3.2%. Back in July, the Federal Reserve completed the first of 2 rate increases that they had promised for the second half of 2023, as the underlying sticky inflation numbers were not coming down as rapidly as they hoped, and employment had not yet turned into a negative trend. Consumers are still spending massively, even as consumer confidence readings were dropping. They've kind of leveled out now, and consumers have accumulated record amounts of credit card debt, now well over $1 trillion, and overall household debt now exceeds $17.5 trillion. Bureau of Labor Statistics reports that unemployment increased to 3.9%, even with the new jobs gains in February of 275,000. Some downward revisions were made for the fourth quarter of 23. We have Table A present that shows you what the values for various employment levels and participation rates and so forth. That's the household data summary Table A from the Bureau of Labor Statistics. This currently solid employment situation continues to keep the Fed free to be as aggressive as they deem necessary in their scripts for rates and in their plans for unwinding their balance sheet, thus decreasing the money supply. They have just implied that their rate increases have come to an end, but there's only been a token reduction in the Fed's balance sheet from about $8.4 trillion to $7.7 trillion, so clearly we believe much more needs to be done in that regard. However, the Open Market Committee has just stated they want to look at ending their balance sheet unwinding soon, and we believe this is probably premature. On the energy picture, OPEC and Russia had previously agreed to voluntary production cuts back in April and August of 23, and then again in February of 24 to support prices for their oil. It now remains to be seen whether these will affect crude prices to any significant degree. Without some geopolitical disruption, such as the new instabilities in the Middle East and around the Straits of Hormuz, that would be perceived to be significant disruptions, we don't see crude prices now moving much higher than the current $80 or so per barrel, and further demand weakness could just as easily drive prices down again. We have a chart by the Energy Information Agency which projected a general seasonal decline in motor fuel prices for the next 2 years. OPEC claims to extend their voluntary production cuts through the second quarter of this year, which now gives the EIA reason to adjust their view slightly upward. Natural gas prices have generally declined significantly as production has clearly overtaken demand again, even with the U.S. exportation of record amounts of liquefied natural gas in the past several months. Daily natural gas production is approaching 105 billion cubic feet per day, which is astounding from a historical context. The EIA expects Henry Hub prices to remain near $3 per thousand cubic feet or less for all of 2024 and 25. Total winter heating bills for gas users should also be significantly lower than last year. Underground storage reserves were already at the high end of their 5-year average range, so prices should remain moderate throughout the last of winter and spring here, which is again anticipated to be warmer than average. The winter storms which recently swept across the country caused a brief temporary spike in regional prices, just as we have recently suggested would happen. However, in the past month, Henry Hub prices have dropped by about 25%, so now may be a good time to look at locking in a lower price for home heating gas over the next year if you have the ability to do so. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.